This housing market is on the brink of an unprecedented crash, with mortgage rates reaching a 23-year high. In October, sales plummeted to levels not seen since the Great Recession, and the number of home listings is rapidly increasing. Sellers are compelled to slash prices to secure deals, marking a significant turning point. Real estate professionals, home builders, and mortgage lenders are growing increasingly pessimistic, reflecting a grim outlook. Americans are anxious about losing home equity or even their homes altogether. Alarming statistics point to an imminent disaster, making it crucial for homeowners and potential buyers to recognize the warning signs. Here are 15 indicators of an impending housing crash, but before we reveal them all, make sure to subscribe to the channel and leave a like below this video. The era of unsustainable price increases has concluded. Home prices skyrocketed by 45% from January 2020 to December 2020, creating a massive bubble. Conditions started to deteriorate as the Federal Reserve raised interest rates to levels unseen since the turn of the century. The average home price fell to $441,000 in the first quarter of 2023 and further to $429,000 in the second quarter. In the third quarter, the average home sold for $46,400, indicating a departure from the trend of unsustainable prices. Mortgage rates remain extraordinarily high, with a national 30-year mortgage interest rate at 7.87%, the highest in 23 years. The Federal Reserve's commitment to keeping rates elevated suggests a prolonged period of expensive mortgages. The current high mortgage rates translate to approximately $3,000 per month for the average new buyer, according to Black Knight. The outlook is bleak, with little expectation of rates decreasing soon. In contrast, the average American earns just $4,600 per month, making a substantial portion of the mortgage payment unaffordable for most individuals and significantly impacting demand. This comes at a time when more housing supply is entering the market. Home sales are experiencing a sharp decline after months of rapid acceleration. A significant drop in home sales, following consistent year-over-year growth, serves as a potential warning sign of an impending housing market crash. Declines in sales volumes can affect home appreciation, and when sellers struggle to find buyers, they are compelled to lower prices to attract more interest. In the third quarter, home sales plummeted by 15.1%, reaching levels not seen since the aftermath of the Great Recession. With mortgage rates nearing 8%, a majority of potential buyers are currently priced out of the market, leaving sellers with no choice but to significantly reduce their asking prices. Sellers and home builders are cutting property prices at unusually high rates. Data from Zillow and Redfin indicates a record number of sellers lowering their listing prices in the past quarter. In September, the percentage of home listings with a price cut surged to 99.2%, and in October, it increased by an additional 7%, an unusually high month-over-month rise. The National Association of Home Builders reported that 32% of home builders reduced prices in the past month, with an average drop of 6% nationwide. Meanwhile, housing inventory continues to grow, with more than 500,000 unsold homes active on the market. According to the National Association of Realtors, the U.S. housing inventory is nearly 6% higher than it was a year ago. A saturated market with homes sitting for extended periods signals diminishing buyer interest. Although not yet at critical levels, rising supply in many markets amid plateauing demand is a significant indicator of an imminent market shift. Shadow inventory, consisting of properties not officially listed but potentially entering the market at any moment, may further impact the housing landscape. There are approximately 5.5 million properties in this category, according to Redfin. If a substantial number of these shadow homes become available for purchase, the market could be flooded with supply, resulting in downward pressure on prices. Distressed properties, foreclosures, and homes held by sellers awaiting better market conditions contribute to this shadow inventory. Buyers are currently lacking confidence. The prospect of a housing market crash is unsettling for homeowners and buyers alike. The fear of holding an overvalued asset while the economy falters adds to the anxiety. The economy operates as a self-fulfilling prophecy. If people believe the housing market is in trouble, there's a higher likelihood it could decline in the near future. The perception of unfavorable conditions is a signal that people are hesitant to invest in a home. Currently, assessing consumer sentiments about housing is possible through Fannie Mae's monthly Consumer Sentiment Survey. The survey gauges opinions on whether it's a favorable time to buy or sell a house. In the latest survey, 85% of respondents deemed it an unfavorable time to buy, with inflation and high mortgage rates cited as the primary reasons. This marked the lowest consumer confidence reading in 11 months, confirming a nationwide cooling of demand. Real estate agents and home builders shared this pessimism. Real estate agents, with their on-the-ground insights, are invaluable during critical periods. According to NAR's Realtor Confidence Index in October, the number of agents expecting increased buyer traffic in the next 3 months declined to 8%, down from 11% in the previous month. Sentiment also dropped from 72 to 64 points from August to October. Additionally, builder confidence, measured by the NAHB/Wells Fargo Housing Market Index, fell 4 points to 40 in October, marking the lowest level since January. Any reading below 50 is considered negative, marking the third consecutive monthly decline in builder confidence. Builders report decreased buyer traffic, especially among younger buyers priced out due to higher interest rates, notes Alicia Woolley, NAHB's chairman. Mortgage lenders are expressing concerns as well. The Fannie Mae Quarterly Lender Sentiment Survey tracks lenders' forecasts regarding profit margins, mortgage loan demand, and mortgage refinance demand. The latest report indicates that lenders are restricting loan access due to rising losses. The delinquency rate for mortgage loans on 1 to 4 unit residential properties increased to 3.62% at the end of the third quarter of 2023, up 25 basis points from the second quarter and 17 basis points from a year ago, according to the Mortgage Bankers Association. This trend signifies a tightening of credit conditions, indicating potential trouble ahead for the housing market. The current state of the housing sector is causing increasing concern, with several alarming developments indicating potential risks and challenges. Risky mortgages could trigger a domino effect. Financial institutions becoming more cautious about lending can lead smaller firms with lower credit standards to offer riskier mortgages. Loosening underwriting standards excessively may result in higher risk mortgages being offered in bulk to buyers who cannot afford the homes, reminiscent of the 2006 to 2007 subprime loan boom that fueled the housing crash. Loans requiring mortgage insurance, with the standard 20% down payment becoming unattainable for many buyers at current prices. Mortgage insurance is increasingly required for those considered riskier due to a lack of a substantial down payment. This poses a significant risk, especially when homeowners without substantial savings purchase homes, potentially accumulating more debt than the home is worth, leading to negative equity. Foreclosures on the rise. An increase in foreclosures, where homeowners default on their mortgage loans, signifies financial struggles on a large scale. Foreclosure activity has been rising for 23 consecutive months, with an uptick of 34% in the third quarter, indicating potential financial distress for homeowners. Potential for a re-inflating housing bubble. Sellers offering price cuts and most buyers being priced out of the market create conditions for speculators to thrive, potentially inflating the housing bubble further. The risk lies in the possibility of a resurgence in price growth, requiring the Federal Reserve to raise rates significantly, which could lead to economic recession or a more significant crash in the future. Cracks emerging in the job market. The cooling job market poses a threat to the economy and, consequently, the housing market. Unemployment has increased by almost a full percentage point since April, historically indicating a potential recession when such an uptrend occurs. Macroeconomic indicators pointing to a downturn. The overall health of the housing market depends on a thriving economy. Economic indicators, such as rising unemployment and a negative consumer sentiment, 78% citing inflation as the primary concern, signal potential challenges for the housing market. Corporate and personal bankruptcies are on the rise, contributing to an environment that could be detrimental to the housing sector. These warning signs collectively suggest that careful attention to local and national housing trends is crucial. Staying informed and ensuring financial stability will be key to weathering the potential turbulence ahead. Let us know your thoughts in the comments below. And please make sure to subscribe to the channel and leave a like below this video.